The point I'm trying to make here is that the way that the economy is running, you're going to see that there's signs that it's running just burning hot and signs that it's crashing into the ground at the same time. And when you turn on the news, you're going to hear people who are so sure of one or the other outcome, and the reality is they have no reason to be that sure. The data just does not, it backs up both, therefore does not back up either. I predicted that recession earnings are likely to happen in 2023. I did say it was a second half of 23 phenomenon, when Wall Street was saying it was a first half phenomenon. It may not even be a 23 phenomenon. Now, when we look at headline CPI, which is the number that everybody, talks about on the news, like the peak was in June. Like, duh. Okay, everyone who's a serious investor has known that for months now. The question is, where does this eventually land? And in order to figure that out, we look at kind of different breakdowns within the CPI basket. So again, this is the Schrodinger's economy part. So the headline is showing inflation as 100% moderating. But when we look at core, right, core CPI, which means you take out the volatile components of food and energy, you see that, again, on a 3-month annualized basis to kind of look for the trend, there is a gentle trend down when you look at the past year or so, but the past couple months, it's like it's picking up again. Again, is this just a bounce before it goes back down, or was this the bottom? I think to be a rational investor, you kind of have to keep both possibilities in mind. Now, what's actually really scary is median CPI, because median CPI has been demonstrated to be the most predictive factor of how sticky CPI is. And median CPI is just not going down, right? It went back up in February, and in March it's hovered, above 7.5%. If that happens again for another month, that's a problem. Right? I think they're just going to keep rates higher for longer. And the reason for that is, nothing's happening with inflation. Right? Like, headline inflation came down because when you're comparing it against 9% year over year, if it doesn't go down from 9, we have a lot of problems, right? So it's down from 9, but it's really just not moving at a pace that the Fed is going to be happy with. And I was talking with Kunwar earlier about this, which is that I think Powell is perfectly happy to keep rates where they are, ignore the banking system, because he can save the banking system with these different lending facilities. Markets are betting through their pricing that the Fed is going to cut 2 to 3 times this year. I think that's wild, right? You have to, they're not going to do that unless there is another GFC on the horizon. And if another GFC happens on the horizon, they're not going to cut 2 to 3 times. They're going to take it down maybe to 2%, maybe even to 0. I don't know, but you kind of have these divergences, right? Either the Fed stays really high or they're going to cut a lot. And this whole kind of mild recession thing, or at least pricing in rates based on a mild recession, that's not the way to think about it. It's very binary in which way things are going to go. Actually, what happened was, if you remember from the chat, I said I sold half of my Bitcoin, half of the Bitcoin position. Had nothing to do with the macroeconomics. It was because there was an update on Ethereum, and my experience told me that whenever people pumped crypto into a major update, you're going to get a sell-off. I was wrong for a day as it ripped up to 31,000, and then it's kind of been down since. So when you go across the board, right, 90% into your treasuries earning 1.33%, half of the Bitcoin position closing out at 81%, and the remaining half at the close of yesterday's price, you get a money weighted return of almost 9%, which is not bad for 4 months. So I'm closing out the trade today because I think the liquidity picture looks shitty for the near term. I didn't put a chart here, but in my videos, I posted this chart right next to the S&P 500, and it's like equities is liquidity now. Like that's that's what it's become, right? And so we can see, guess what happened mid-March to April that might have made liquidity spike. And I flagged this. I said the authorities are going to reliquify the system to save the banking system. And one of the side effects is that asset markets, specifically ones that are sensitive to liquidity, are going to go to the moon. So what do we see? We saw Bitcoin go from 19.8, right at the fever pitch of the Silicon Valley Bank debacle, to 31,000, and it's coming off. Oh, interesting. When did it start going down? Right? So again, monitoring liquidity can help you make a reasonable prediction as to what liquidity sensitive assets are going to do. Okay. So a couple things as well. So the Fed balance sheet makes sense. I think that this is just how much is the Fed printing. That one's easy. How does the Treasury feed into that? Well, when the US government taxes you, what do you have to do? You have to pay, right? Thank you, Nick. A+, honorary Asian. So when you give the Treasury money, can you then go buy Bitcoin with that money? No, right? So that's how the Treasury sucks liquidity out of the system. Another way that they suck liquidity out of the system is they raise debt because they don't have enough money, right? So what do? They issue a bond. So instead of taxing you, I'm selling you a bond. You give me your money because you're buying the bond. Can you use that money that you bought the bond to buy First Republic Bank stock? No, right? So, so how does the Treasury take liquidity out of the system? Taxing and issuing debt. What do we know that's going on right now? They have not been able, officially, let's ignore extraordinary measures for the moment, they could not issue more debt since January. So what does that mean? Everything that they're spending on enters the system, and all their mechanisms to pull money out of the system, they can't use the debt lever, right? So again, this was something that I flagged in January. I said liquidity is coming to the system because the Treasury needs, they can't raise any more money. And this is what I was talking about. And you notice that they did get a little bit of a tick up. That's because that was tax day. But they can't raise anymore. So this is just a one-way street down until everything just gets wiped out, which the new X date is estimated when? Anyone know? June 1st. So less than a month. Everyone was predicting August at least, so. That one event will move market. This has been the most forecasted recession ever, right? If you look at charts, like this is the first time that economists and market participants are actually saying there's going to be a recession. Every time a recession has happened, everyone's like, we're going to get positive growth this year. And it just, like a model created by Bloomberg Economics puts the risk of 100%. So whether we get a recession or not, I mean, I am in that camp. I think most likely we are going to get a recession. But the fact that it's so well known means that people have prepared for it, right? Businesses starting to cut down their spending. They're not making the same level of capital investments as they would if there was an economic boom. People are saving. I forgot if I put this slide in, but the personal savings rate has been through the roof this year. Again, because people are making more, they're not getting taxed on it, and they're like, oh crap, if a recession's coming, I should just save it, right? They've been able to both increase their consumption and spending and still have more to have the highest savings rate that in the most recent past. So the thing that I'm trying to say is the observation of this potential event happening could be altering the actual event itself. Maybe that means it gets pushed out even further. Maybe it means that, you know, the economy stays afloat long enough for inflation to finally come down and the Fed can move itself from restricted territory, and then we're at a new cycle. Maybe.